Current price, $2.02. Closed Friday, November 28, 2025. Market status, closed. Weekend. Intraday movement last session, plus $0.04, plus 1.79%. The screen right now shows Plug Power stock sitting at exactly $2.02. On Friday, we saw the stock push up by roughly 1.8%, closing the week with a bit of green on the board. You might look at that price, barely holding on to the $2 handle, and think this is just another beaten-down ticker gasping for air. That is the expectation. The narrative floating around every investment forum and Discord channel is that Plug is a dead man walking, a company burning cash so fast that it's destined to dilute its shareholders into oblivion or simply cease to exist. That is what the bears want you to believe. That is the surface-level story. But the reality is significantly more complex and, frankly, far more interesting than a simple bankruptcy thesis. While everyone is fixated on the cash burn of the past, something critical shifted in the last few weeks that most retail investors completely missed. We are looking at a company that has just executed a massive financial pivot, raising nearly $400 million in net cash through a convertible note offering that essentially clears their immediate liquidity runway. You expect a company running on fumes. The reality is a company that just refueled its tank right before a massive regulatory catalyst, the 45V hydrogen tax credit, finalization is about to hit. This isn't just a penny stock gambling on a dream anymore. It's a battleground stock where over 300 million shares are currently sold short. That is roughly 23% of the entire float betting this goes to zero. If the reality of their turnaround exceeds the grim expectation of their demise, we aren't just looking at a recovery, we are looking at the mechanics of a massive short squeeze. Let's strip away the noise and look at what is actually happening with Plug Power stock right now. You see that price of $2.02, that is a psychological line in the sand. For the last few months, this stock has been hammered by fears of liquidity. The expectation was that Plug would run out of money before the end of 2025. But just days ago, they closed a convertible senior notes offering, securing hundreds of millions in fresh capital. Why does this matter? Because it buys them time. And in the hydrogen sector, time is the most expensive commodity. When you look at a company like this, you have to ask yourself, why are institutions like Goldman Sachs increasing their positions? Our data shows Goldman increased their stake significantly in the most recent filing period. Do they like losing money? Probably not. They see what the retail crowd is missing, the reality that Plug Power is transitioning from a science experiment into a commercial industrial giant. But before we go further, I want to challenge you. Comment below how many shares of Plug Power you currently hold and tell me, do you think the hydrogen economy is a 5-year play or are we 20 years too early? I want to see where your head is at because the timeline here is everything. Now, let's talk about the elephant in the room, the dilution. On January 15, 2026, Plug Power is holding a special meeting of stockholders. The agenda? To double the number of authorized shares from 1.5 billion to 3 billion. When you hear double the shares, the immediate reaction, the expectation is panic. They are going to flood the market. My shares will be worthless. That is the knee-jerk reaction. But let's look at the reality. Why do they need 3 billion shares if they just raised cash? It's not necessarily to dump them all tomorrow. It's about having the dry powder to negotiate with major strategic partners who might want an equity stake in exchange for massive infrastructure deals. It's about survival insurance. Consider the broader context. We are living in a time where online investment platforms like Schwab Intelligent Portfolios and SoFi Invest are seeing a surge in retail interest in clean energy, yet the sentiment on Plug is at rock bottom. This divergence is where opportunity lives. If everyone loved Plug Power right now, it would be trading at $30, not $2. The fact that it is hated, heavily shorted, and facing a binary outcome event in January creates a tension that is rare in the market. Let's look at the charts and the tape. The volume on Friday was around 45 million shares. That is lower than their average, suggesting that the sellers are getting exhausted. When volume dries up at the bottom of a massive downtrend, it often signals that there is no one left to sell. Everyone who wanted out is out. Now you just have the shorts pressing their bets and the long-term believers holding on for dear life. If we get one piece of good news, say a finalized Department of Energy loan guarantee or a specific update on the 45V tax credit that favors Plug's electrolytic hydrogen, those 300 million short shares have to cover. And when they cover, they become buyers, panic buyers. The business model itself is also misunderstood. Most people think Plug just makes forklifts. The expectation is it's a forklift company. The reality is that Plug Power is building the entire hydrogen ecosystem. They aren't just selling the fuel cells, they are building the plants to make the liquid hydrogen to fuel them. They are becoming the Exxon of hydrogen, or at least that is the goal. They recently delivered the first 10 megawatts of electrolyzers to Galp Energia in Portugal. This isn't a PowerPoint presentation, this is heavy industrial equipment being shipped and installed. They have operational plants in Georgia, Tennessee, and Louisiana. The Georgia plant recently hit a record production month. This proves the technology works at scale. The risk isn't can they do it, the risk is can they do it profitably. This brings us to the most critical reality check, gross margins. For quarters, Plug has been selling its products for less than it costs to make them. That is a recipe for disaster, and it's why the stock is down 90% from its highs. But in the Q3 report, we saw a glimmer of hope. Margins are still negative, yes, but they are improving. The cash burn is slowing. The company is actively raising prices and walking away from unprofitable deals. This is the discipline that Wall Street has been begging for. The expectation is that they will continue to bleed money forever. The reality is that management has been swapped out and reshuffled to focus purely on execution and cash flow. The new leadership tone is somber, serious, and focused on the bottom line, not just hype. Think about how you invest. When you use tools like Fidelity Investments or Interactive Brokers, you have access to deep data. You can see the short interest. You can see the institutional flows. But data without context is useless. The context here is the 45V hydrogen tax credit. This is a government subsidy that could pay Plug Power up to $3 for every kilogram of green hydrogen they produce. If the final rules allow for book and claim, essentially allowing them to use renewable energy credits to qualify, it is a game changer. It instantly makes their hydrogen competitive with diesel. The market is pricing in a worst-case scenario for these rules. If the reality is even slightly better than worst case, the stock has to re-rate higher. Let's pause and think about the macro picture. We are in a high-interest rate environment, though rates have stabilized. Growth stocks like Tesla stock, Apple stock, and Nvidia stock have all had to adjust to this new normal. But for a capital-intensive business like Plug, high rates are brutal because borrowing money to build plants is expensive. That is why the recent convertible note raise was so vital. It was expensive capital, yes, but it was available capital. It took bankruptcy off the table for the immediate future. Now, I want to address the psychology of the shareholder here. If you are holding Plug Power, you are likely suffering from battered investor syndrome. You have seen every rally get sold into. You have seen every promise get delayed. The expectation now is that any pop is a selling opportunity. This sentiment is incredibly powerful because it keeps a lid on the price. But it also acts like a coiled spring. When the sentiment finally shifts, when the reality of a sustainable business becomes undeniable, the rush back in can be violent. We saw this with Tesla stock back in 2019 when everyone thought they were going bust. We aren't saying Plug is the next Tesla, but the sentiment mechanics are similar. Extreme pessimism often marks the bottom. Let's discuss the short squeeze mechanics in more detail. With over 300 million shares short, Plug Power has one of the largest short positions in the entire NASDAQ. The days to cover ratio is creeping up. That means if all the shorts wanted to buy back their shares at once, it would take days of buying at normal volume to do it. This creates a trap. If positive news drops, perhaps a major partnership with a data center giant looking for backup power, the shorts will scramble to the exit simultaneously. But there are no shares to buy because the diamond hand retail investors aren't selling at $2. This supply-demand imbalance is what causes a stock to double or triple in a week. We should also look at the competitive landscape. You have companies like Bloom Energy and Fuel Cell Energy. Bloom has been performing better recently because they are more focused on natural gas and solid oxide fuel cells, which are more here and now. Plug is betting on the pure green hydrogen future. This makes Plug a higher beta